Hi, I'm Louis McGraw with McGraw Realty.
Ken Martello from RPM Mortgage, Platinum Capital.
Beth Brooks, professional life coach.
All right. So Ken, today on this segment, one of the things that people look at is they're in a current mortgage right now. They're the existing property, they've been there for 2 years, 5 years, whatever the case may be. But the one thing that we know, and it just came out, that the rates are going to stay the same over the next 2 years. So what's the benefit of someone to stay in their current mortgage versus a refinance?
Well, with a refinance, what you're actually doing is you have a mortgage at a particular interest rate, and we'll compare that to, and you got that mortgage 2, 3, 5, 10 years ago. We'll look at what you have on that current mortgage and what that current payment is versus what interest rates are today.
Okay.
So over the last 2 weeks, and today is August 19th, 2011, we've seen rates drop down about 3/4 of a point. You see a huge dip. So it allows a lot of people to then take a look at what they're paying and then compare it to the market. And if we can get 4.25 type rate and they're at 5, 5.5, 6%, it would make sense to compare the numbers and hopefully save some money every month.
Okay.
Now, do you look for, I know a lot of people are here talking, they're waiting for the bottom. Where's the bottom? Should you be waiting for the bottom, or should you be looking for a certain percentage that you're going to save regardless? I mean, is there a philosophy there that you should think about, and you know, no one really knows, I guess, where the bottom is.
What my formula is that whether I pay the cost or whether the consumer pays the cost, you'll hear these terms, no cost refi. There's always going to be cost, it's just a matter of who pays them. So on a no cost refi, say if rates are at 4.25, instead of getting a 4.25, maybe you're at 4.625, you're still saving money, but you're not paying out of pocket or rolling the cost into the loan. So my general rule of thumb is if we can pay for the cost in less than 3 years, then it makes sense.
Okay.
If it's under 2 years, it's something that you should act quickly on, and if it's under a year, which we barely ever see, you should have did this last month.
You know, when I first got in the real estate industry, one of the mentors that I was dealing with said that there was a 2, 2, and 2 factor with real estate when you do a refi, and what you were looking for was a 2-point drop, $200 a month, or you're going to be in the property for 2 years. Tell me, does that make any sense today?
It definitely does. If 2%, you're typically not seeing people with a 2-point drop, because we saw very low rates in the 2000 to 2005 range. So if you probably refied or you bought a house at that point, your rate's pretty low, and then it started creeping up between 2006, 2008, and hopefully those people have equity so they can still refi.
Right.
And then over the last couple of months, you know, we're in 4.75 to 5.5 type range. So sometimes we're only saving 3/8, maybe a half point in rate. But again, I look at what's the cost to achieve that savings.
Right.
So if I'm going to save $100 a month, and my costs are going to be $3,600, I got to be in that loan 3 years to recoup that savings. That's typically a good deal, but if it's going to be, the cost is going to be $4,000, it's going to now be 3.5 years, then I would probably hold off and see if rates drop a little further.
But at the same time, on your final HUD-1 and closing statement, some of those points and fees are tax deductible, aren't they?
That's correct, but you know, I'm just looking at straight out of pocket or what's going into the loan.
Okay.
So you can look at it as I'm going to deduct some of the points and some of the cost in there. Talk to your CPA about what you can and can't do. But I look at it a little more simply. What am I spending out of pocket today? What am I putting into the loan to achieve those things?
Now, another question that I know a lot of people that I come into contact with have is that, is the bank only looking at the equity in a property when it comes to refinancing? I know some people are thinking, I should refinance because I've lost my job, I need to cut down expenses. Will they still need to qualify for that refinance in the same type of way they would if they were purchasing a new home, or is it strictly based on equity?
Yeah, unfortunately the bank is going to look at it as a new loan. There are some cases where we can look at it as what they call a streamlined version, so the paperwork is not as tedious as a typical loan. But unfortunately, without a job, it's going to be very tough to do a loan. So, you know, I have some clients that knew a layoff was coming, and they'll come to me and even in a case like that, the employer has to say that, no, they're going to be employed, so that might be a tough situation.
Right.
How about credit scores and debt? If they are employed, but their credit score isn't the same as it was when they originally bought that house and got that mortgage, but they're looking at refinancing.
Depending on the loan, whether it's FHA or conventional, that may or may not be a big issue or not. You mentioned equity before, and that's one of the first things I actually look at is, do we have equity in the property to actually order an appraisal? So I'm going to look at comps online, get a feel for what's happening in that neighborhood. If we lost some equity, are we still at 80% loan to value? If we're above that, there's some cases that we can still work with that client. They're limited though, so we look at each case by case.
Okay. Now, Ken, in one of my other segments of a video that was recorded, I spoke with the consumer, or I addressed the consumers about renting the property. So let's just say this person has a property, there's equity in it.
Okay.
And they know that, hey, life changes, the debt, all these things have come across that are affecting the way that they live now. So they don't want to sell the property, but they're looking at maybe refinancing that property to a lower rate because they know that they won't be able to afford it any longer, but then to rent it out. Okay. Now, if someone were able to refinance that property with the intent of renting it out, is there a time frame that they must live in that property before they can rent it based on the loan docs, just to make sure?
That's actually a pretty good question, and it's we see that a lot when someone, maybe in a little different way, where someone's living in the house and they want to go buy another house, and they want to take cash out of the first house to go buy the second house, or they're just going to rent it out. They don't need the cash, and they're going to live in that other house, but they want to refi that house before they leave to get owner-occupied rates instead of an investment rate.
Right.
If you know that you're not going to live in the property for the next year, you should put that it's going to be an investment property.
Right.
Otherwise, you're doing some mortgage fraud, and we're not going to go too deep into that.
None of that has happened over the last 5 years, Ken.
That's part of the reason why we're in this mess. But it's actually an issue, and what I've seen on some agents have come to me where their clients recently refied on the loan application, on the loan docs, and there's actually a form you sign when you sign your loan docs.
Right.
It says that you're going to live in the property, typically for the next year.
Right.
And then they refi, and then right away they're in escrow. They're in escrow when they're refining. So what the lender's going to do is going to say, okay, you just refi, let me see the loan application. It's going to clearly say owner occupied, and it's going to create issues on the uplight property.
Now, do people, this might be important because things are changing in this economy and things do happen in life. If I write on my application, I intend to live there for the next year, and 6 months from then, I have a change in my life happens. I lose a hardship.
Well,
Is that still fraud if I did in fact intend, but something changes?
it really goes to the intent. So with a couple that they're in escrow on another property, clearly the intent is to move into the other property, and they put owner occupied to get that lower rate. And what would happen actually when people move, they usually move up. So what would actually happen is they get the lower rate on the lower loan amount, and on the higher loan amount, they're going to get a higher rate because they didn't do it right from the get-go.
Right.
And they think that they're going to pass one over on the bank. The underwriters are very smart, and they're going to look at that and say, it doesn't even make sense.
Okay.
In your case, say if we got laid off from the job, say if we got transferred, say if we are in a house and I recently had a baby, so as soon as the baby came, it didn't happen the prior 9 months, but as soon as the baby came, I was like, I want to buy a new house. I need a new house. This house is too small.
Start looking at school districts differently.
I need a yard, I need a school district. So there are life changes that you could have some flexibility on that year rule. But again, it comes down to does it make sense and what's the original intent.
Right. And I know when I was more on working with a lot of investors a couple years ago, it was more along the 50.1 mile rule. Does that still apply as far as buying another property?
So that would be more of a second home scenario. So I think the question was, if you're over 50 miles, does this scenario change? So typically, again, it goes to intent. If the person is intending to rent the property out, that's what we're going to put on the loan application. If the person is intending it to be a second home, then that's what we're going to put. But you also got to look at the location. If the second home is at the beach, it makes sense. If it's just in the middle of the suburbs, that's not going to make sense as a second home. And then also the bank is going to look, does it make sense that this person is buying a second home? So if you got someone that's making 50 grand a year, the chances are that they're buying the property as an investment, because the affordability of having two properties is going to be very difficult. So they're looking at a lot of things, and keep in mind, like I said, the underwriters are very smart, especially my underwriters, so they're not going to let something like that
Right.
slide.
You can't say, but I have like 4 teenagers and I really need 2 houses to sell.
That's a life circumstance that
Okay.
we could maybe make the case for.
Okay.
Yeah, all right, well, very good. Any more questions, Ms. Beth?
No, I think you've covered a lot and you've given
Thank
us
you,
a lot
guys.
of really useful
Absolutely.
information, so thank you very much.
Thank you very much. And if you would, before we close, if you would give your contact
Definitely.
information.
So once again, it's learntobuyahome.com. That's the number 2, so learntobuyahome.com. And then my direct line, if you want to get a hold of me, is 310-465-2326.
Very good. Thank
Thanks,
you very
guys.
much.
Thank you.